When you find a prior year mistake, your brain often does something called catastrophic projection. You jump from, I forgot a 1099 to, they're going to audit 3 years to, they're going to assess penalties to, this will destroy everything. That leap happens in seconds. But the IRS does not operate in leaps. It operates in procedures. It's a random Tuesday night. You weren't even looking for trouble. Maybe you were organizing your downloads folder. Maybe you were clearing out old emails. Maybe you were finally trying to get your bookkeeping system cleaned up for this year, and then you open it. A prior year tax return. Maybe 2022, maybe even older. You scroll. You glance at Schedule C. You see a number that looks slightly off. Or you notice a 1099 you now realize never made it onto the return. Or you find a bank statement that proves you underreported income, and suddenly your chest tightens. Your brain jumps straight to catastrophe. They're going to think I lied. They're going to say I committed fraud. I'm going to get audited. This is going to unravel everything. You imagine the IRS as some omniscient force, just waiting to discover your mistake. You picture the ghost of taxes past, hovering over your business like unfinished business from a previous life. Let's slow this down, because the emotional reaction to finding a prior year error is usually wildly disproportionate to the procedural reality. Welcome back to the Zero Fluff Books Podcast. I'm Twitchell, and today we are exercising that ghost. Here's the Zero Fluff truth. The tax system is not built as a one-shot, irreversible event. It is built as a reporting system with correction mechanisms. That's not optimism, that's structure. The Internal Revenue Code anticipates that humans make mistakes. Information arrives late, documents get lost, math gets miscalculated, mileage logs get reconstructed imperfectly, and 99s show up in March after you filed in February. The system expects imperfection, which is why the system contains a formal mechanism for correction. It's called an amended return. Now here's the part that most people don't understand. When you find a mistake yourself, before receiving a notice, that is not a crisis moment. That is a compliance moment. You are discovering an issue before automation does, and that gives you leverage. Today we're going to walk through this calmly. We're going to talk about why finding your own mistake is actually a good thing, how Form 1040X functions as your edit button, what my obligation is under Circular 230 when I see prior year errors, how far back the IRS can actually assess additional tax, and when they cannot, and why amending is not an automatic audit trigger despite what the internet insists. If you've ever looked at a past return and thought, I hope they never notice, this episode is going to replace hope with process, because hope is emotional, process is stabilizing, and once you understand how fixable this system actually is, the ghost loses its power. Let's talk about how the IRS actually views human error. Let's start with something that might surprise you. The IRS does not operate under the assumption that every error is fraud. It operates under the assumption that humans file tax returns, and humans make mistakes. That distinction matters, because when you discover a prior year error, your brain jumps straight to intent. They're going to think I meant to do that. But the IRS evaluates intent differently than your anxiety does. Inside the system, there is a difference between negligent, substantial understatement and civil fraud. Those are not interchangeable, and most ordinary small business errors fall into the first category, if they fall into anything at all. Let's ground this in reality. If you forgot to include a $3,000 1099 because it was sent to an old email address, that's not fraud. If you miscalculated mileage because your log wasn't perfect, that's not fraud. If you accidentally double counted a deduction or missed one entirely, that's not fraud. Fraud requires intent. Intent requires evidence. The IRS does not infer intent from a math error. Now let's talk about automation. The IRS processes millions of returns every year. The system relies heavily on information matching, B2s, brokerage statements, payment processor reports. If something is materially mismatched, a notice may generate automatically. Not because someone manually reviewed your file, but because the system flagged a discrepancy. That's procedural, not personal. Now here's the important part. If you discover an error before receiving a notice, you are ahead of automation, and that is powerful. Because voluntary correction carries different weight than reactive correction. The IRS always has encouraged voluntary compliance. The entire system is built on self-reporting. You calculate your income, you calculate your tax, you submit it. That's extraordinary when you think about it. The government is trusting you to do the math, which means the system anticipates self-correction. And that's why amended returns exist. Let's zoom out for a second. If the IRS believed tax returns were permanent, unchangeable declarations, there would be no Form 1040X. there would be no mechanism for adjustment. But there is, because the system expects humans to revisit their numbers. Now let's talk about something that causes unnecessary fear. People assume that if they amend a return, they are raising their hand and inviting scrutiny. But amending is not a red flag by default. It is a correction mechanism. If you discover that you underreported income and you amend to include it, you are increasing your tax liability voluntarily. That is not suspicious behavior. That is compliance behavior. If you discovered you missed a legitimate deduction and amend to claim it with documentation, that is not inherently suspicious either. It's a correction. Now let's address proportionality. A $500 error is different from a $50,000 error. Magnitude matters, but even magnitude does not automatically imply fraud. It implies significance, and significance requires response, not panic. Now I want to bring this back to emotional reality. When you find a prior year mistake, your brain often does something called catastrophic projection. You jump from, I forgot a 1099 to, they're going to audit 3 years, to, they're going to assess penalties, to, this will destroy everything. That leap happens in seconds, but the IRS does not operate in leaps. It operates in procedures. There are statutes of limitations. There are thresholds. There are notice cycles. There are structured steps. This is not a chaotic system. It is bureaucratic. Bureaucratic systems move in sequence, and sequence is predictable. Now let's talk about something else that brings perspective. The IRS knows that documents arrive late. 1099s get corrected. K1s arrive in August. Brokerages issue amended forms in March. The system is built around imperfect timing, which is why amended returns are common. Very common. Tax professionals file them regularly. Individuals file them regularly. They are not rare events. They are administrative adjustments, and that framing matters. Now let me say something clearly. Discovering an error and ignoring it is where risk increases. Discovering an error and evaluating whether amendment is appropriate is where control increases. You do not lose control when you find a mistake. You gain information. Information lets you decide, is this material? Does it change tax? Does it require correction? Or is it immaterial and not worth procedural adjustment? That analysis is calm. It is not emotional. And that's the shift we're making in this episode. The IRS expects humans. Humans misplace documents. Humans miscalculate occasionally. Humans reconstruct records imperfectly. The system does not implode because of that. It provides correction pathways. And the most powerful position you can be in is discovering your own error before automation does. Because proactive correction is always more stable than reactive response. Now let's talk about that correction pathway specifically, because understanding how Form 1040 actually works removes most of the remaining fear. Let's move into that next. Let's take the mystery out of this. An amended return is not a red flag. It's not a panic form. It's not a signal flare to the IRS. It's simply a correction document. For individuals, that document is form text, and here's what it really is. A side-by-side comparison. That's it. When you file an amended return, you are showing 3 columns. What you originally reported, what the corrected numbers should be, and the difference between the two. That's the structure. You're not rewriting history. You are not erasing the original return. You are disclosing the change, and disclosure matters. The IRS keeps the original return on file. The amended return does not replace it. It adjusts it. Now let's talk about what triggers the need for an amendment. An amended return is generally appropriate when income was omitted, a significant deduction was missed, filing status was incorrect, dependents were incorrectly claimed or omitted, credits were claimed incorrectly, or when any changes affects your tax liability in a meaningful way. Notice the phrase affects your tax liability. If you discover a typo in your address, that doesn't require amendment. If you miscategorize $50 in office supplies, that may not require amendment. Materiality matters. We are not amending for cosmetic corrections. We amend for financial impact. Now let's address a big fear. What if amending triggers an audit? There is no rule that says filing a 1040X automatically triggers examination. That belief is persistent online. It is not supported by procedural reality. Remember what we discussed in prior episodes. The IRS evaluates numbers, not emotions. If you amend to include omitted income and increase your tax, that aligns your reporting with information returns. Alignment reduces mismatch. If you amend to claim a deduction and you have documentation, that's also procedural. An amended return that makes logical adjustments does not scream audit. It says correction. Now let's talk about timing. Generally speaking, you have 3 years from the original filing deadline to file an amended return and claim a refund. That's the general statute for refunds. There are exceptions in certain circumstances, but 3 years is the standard window most people operate within. On the assessment side, the IRS also operates under statutes of limitation. For most returns, the IRS has 3 years from the date of filing to assess additional tax. There are extended statutes in cases of substantial understatement or fraud, but ordinary mistakes generally fall under the 3-year framework. Statutes matter because they create boundaries. The system is not infinite. It operates within time limits. Now let's talk about process. When you file an amended return, it goes through processing. It can take time. Amended returns are often processed manually. They are not always as fast as original e-filed returns. Patience is required, but waiting is not danger. It is queue management. Now I want to address something important. Amending does not mean you are volunteering for deeper review. It means you are correcting discrepancy. If the change is straightforward, for example, adding a missed 1099, the IRS system often matches it cleanly once processed. If the change increases tax owed, you pay the difference. Interest may apply from the original due date to the payment date, but interest is math, not punishment. Now let's talk about something subtle. If you amend to claim an additional deduction, that reduces your tax and that deduction is substantial, documentation becomes more important. Not because amending is suspicious, but because larger changes attract proportionate scrutiny. That's common sense. If you add a $500 expense, that's minor. If you add a $40,000 deduction, that deserves strong documentation. Magnitude influences attention, but magnitude does not equal wrongdoing. Now let's address a scenario that creates panic. You discover that you underreported income from 2 years ago. The correct approach is not to freeze. The correct approach is to calculate the impact. What is the additional tax? What is the interest exposure? Is amendment required? Most of the time, clarity reduces fear. Because when you run the numbers, the correction is often manageable. And when it's manageable, it becomes a plan, not a catastrophe. Now let's talk about professional obligation. Under Circular 230, if I become aware that a client omitted income or claimed an incorrect deduction in a prior year, I have a duty to inform them of the error and the potential consequences. I cannot ignore it, but informing is not the same as accusing. It's procedural. I explain the issue, we assess materiality, we determine whether amendment is appropriate. That's a compliance conversation, not a moral judgment. Now here's the most powerful mindset shift. An amended return is not an admission of wrongdoing. It is participation in a self-correcting system. And systems that allow correction are inherently more stable than systems that don't. You are not confessing, you are reconciling. That distinction changes everything. Now let's talk about how far back this really goes, because the phrase statute of limitations is about to remove a lot of unnecessary fear. Let's go there next. Now let's talk about the clock, because nothing fuels anxiety like the idea that the IRS can reach infinitely back into your past. It can't. The tax system operates on statutes of limitation. That means there are time limits, legally defined windows within which the IRS can assess additional tax. Outside of those windows, assessment generally closes. Let's break this down simply. For most individual income tax returns, the IRS has 3 years from the date the return was filed to assess additional tax. That's the standard statute, 3 years. If you filed your 2021 return on April 15, 2022, the general statute would expire 3 years from the filing date. Now, there are important exceptions. If income was understated by more than 25% of gross income, the statute may extend to 6 years. If a return was fraudulent, there is no statute of limitation. If a return was never filed, the statute never begins. But here's the key. Those extended scenarios are not the norm. They're tied to substantial understatement or fraud. Most ordinary small business errors fall into the standard 3-year framework. That matters because when you discover a prior year mistake, your brain often jumps to, they're going to look at everything forever. But the system does not operate in perpetuity. It operates within defined windows. Now let's talk about what this means practically. If you discover a small income omission from 4 years ago and the statute has expired, the IRS generally cannot assess additional tax for that year. The window has closed. Now, this does not mean you should ignore ethical obligations, but it does mean the procedural risk is bounded. Boundaries lower fear. Now let's flip the perspective. If you discover an error within the open statute period, say last year or the year before, you are still within that 3-year window, which means if the IRS discovers that discrepancy first through information matching, they may send a notice. But here's the shift. If you discover it first, you can evaluate amendment proactively. Proactive correction within an open statute is often clearer than reactive correction after a notice. Now let's address the word fraud, because it tends to get thrown around loosely online. Fraud requires intentional wrongdoing. It requires affirmative acts to conceal income or mislead. It is not triggered by math errors. It is not triggered by imperfect mileage logs. It is not triggered by late arriving temps. Fraud is a high threshold, and invoking that word casually creates unnecessary panic. The vast majority of prior year corrections fall into the category of ordinary mistakes, not fraudulent conduct. Now let's talk about substantial understatement. If more than 25% of gross income is omitted, the statute can extend to 6 years. Notice what that means. If you reported $100,000 of gross income and omitted $30,000, that could potentially trigger the 6-year statute. But omitting $3,000 on $100,000 does not. Magnitude matters, proportion matters. Now let's add perspective. The IRS does not automatically examine every return within the open statute window. Selection is data-driven, it is resource-driven, and it is not universal. The statute simply defines how long they can assess if something is identified. Now let's talk about something empowering. Statutes create urgency, but not panic. If you discover an error in a year that is still open, you have a decision window. You can amend, you can document your analysis, you can prepare for potential correspondence, but you are not trapped in an infinite timeline. The clock exists, and clocks provide structure. Now I want to address something subtle. People often fear that amending one year opens up other years. Filing an amended return does not automatically reopen prior closed years. Each tax year stands on its own statute. The IRS evaluates years independently, though patterns can matter in certain contexts. But the act of amending 2023 does not automatically extend 2021 statute. That's not how it works. Again, procedure over panic. Now let's zoom out emotionally. The ghost of taxes past feels scary because it feels timeless. It feels like something that could surface at any moment. But once you understand that there are statutory windows, that feeling changes. It becomes, what year was it? When was it filed? Is the statute still open? That's analytical, not emotional. And analytical thinking stabilizes anxiety. Now here's the most important shift. The clock works both ways. If you are owed a refund because you missed a deduction, the 3-year statute applies there too. If you wait too long, you lose the ability to claim it. So the statute is not just about risk, it's about opportunity. It defines the window for correction in both directions. Now let's bring this home. If you discover a prior year error, first identify the year. Second, determine whether the statute is still open. Third, calculate the impact. Fourth, decide whether amendment is appropriate. That's the sequence. Not panic, not spiraling, sequence. Because sequence turns ghost into checklist, and checklists are manageable. Now let's close this episode with the most important mindset shift of all. Finding your mistake does not make you vulnerable. It makes you informed. And informed taxpayers operate from strength, not fear. Let's bring this back to where we started. You're scrolling through an old return. You see something that doesn't look right. And for a moment, your stomach drops. But here's what I want you to remember. Finding your own mistakes is not a crisis. It's awareness. And awareness is power. The tax system is not designed as a one-shot, irreversible declaration of perfection. It is a reporting system with built-in correction mechanisms. There is an amended return form. There are statutes of limitation. There are procedural notice cycles. There are defined pathways for correction. That is not accidental. That is structural. The system expects humans. Humans misplace documents. Humans file before all 1099s arrive. Humans miscalculate mileage. Humans forget deductions. The difference between risk and stability is not perfection, it's response. If you discover a mistake and you evaluate it, anxiety shrinks. Maybe it's immaterial. Maybe it doesn't change your tax. Maybe it requires amendment. Maybe it falls outside the statute window. Those are analytical questions, and analytical questions replace catastrophic thinking. Now I want to address something directly. You are not in trouble simply because you found an error. You are not on a secret list because you're reviewing past returns. You're not being monitored in real time because you noticed something off. The IRS is procedural. It moves through automation. It operates on statute. It evaluates numbers. It does not read your mind, and it does not attach morality to arithmetic. If amendment is appropriate, you file it. If additional tax is owed, you pay it. If documentation needs strengthening, you strengthen it. And then you move forward. That's compliance, not confession. Compliance. Now let's zoom out even further. Business ownership means growth. Growth means complexity. Complexity increases the probability of minor errors. That's not failure, that's scale. The goal is not to eliminate every mistake. The goal is to build systems that catch them earlier next time. Monthly reconciliations, information return matching, mid-year reviews, clean documentation habits. Those habits reduce the chance that the ghost of taxes past appears again. But if it does, you know how to handle it. You identify the year, you check the statute, you calculate the impact, You decide on amendment, you respond, that's it. No spiraling, no catastrophic projection, just sequence. And sequence is stabilizing. So if you're sitting there with an old return open and a sense of dread in your chest, close the dread, not the file. Review it calmly, write down what you found, run the numbers. If you need help evaluating materiality, get help, but do not let fear turn information into paralysis. The ghost only has power when it's undefined. When it's defined, it's just paperwork. Next week, we're going to talk about something that prevents this exact anxiety: reconciliation rhythm. How monthly financial review eliminates 80% of prior year surprises before they become surprises. Until then, remember, the IRS expects humans. The code allows correction. The clock creates boundaries, and informed action beats silent worry. I'm Lauren Twitchell, and this is the Zero Fluff Books Podcast, and we'll talk again soon.